Infinite banking depends on some pretty special conditions and laws that apply to the cash value accounts of whole life insurance, particularly whole life policies that are issued by mutual companies and that participate in the dividends those insurance companies pay to their participating whole life policies. And that is what I will be discussing here. And if you watch all the way to the end of this video, you will be invited to take advantage of a valuable free offer, no strings attached, and something I believe you will get a lot of benefit from. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultant. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. Now, if you find this to be helpful, please like this video and subscribe to this channel and share it with your family and friends. Also, please post your questions and comments here. Now, I should be clear about this. The special conditions and laws I refer to affect nearly all whole life insurance policies. And so, any whole life policy that grows cash value may be used for the infinite banking strategy. But, for example, those whole life insurance policies that are designed specifically to provide funds to cover final or burial expenses often do not have a cash value account associated with it. So obviously those policies are not suitable for infinite banking at all. And not all insurance providers are equal when it comes to the design options available, the actual function of some of the riders, and the policies governing how policy loans are treated. First, most insurance providers are stock companies, not mutual companies. So stock companies typically do not pay dividends to their whole life policies. Policies with those stock companies, regardless of the design options they may offer, grow the cash value accounts much slower than the mutual companies. All insurance providers that offer cash value accounts with their whole life policies pay relatively high compounding interest to the cash value of their policies. Most pay between 2 and 3.5% annual compounding interest. Some pay a little more, some pay a little less. The actual interest paid is determined by the insurance provider. Mutual companies pay a stated minimum interest rate and a dividend on top of that, which is determined by the company on an annual basis based on the profits of the company. This annual compounding dividend on top of the minimum guaranteed interest rate is called the dividend interest rate. I like to emphasize that this dividend interest is compounding, which means that the interest paid is paid not just on the principal, but on the accrued interest as well. Einstein called compounding interest the eighth wonder of the world, and it really is a wonderful thing. Also, the interest charged by each insurance company on policy loans is determined by the company. So that varies widely. Average interest charged on policy loans is about 6%. Some charge more, some charge less. Then there's the recognition policy. It's kind of weird in my opinion, but there are two ways insurance companies view policy loans. One way is that the policy loan is being funded by the insurance company's general fund, and your cash value is being used as collateral for the loan. So the loan is viewed as just a loan from the company that you are providing collateral for. That's referred to as non-direct recognition. The other way many companies view policy loans is almost as if the loan is being funded by the cash value in your policy account. As a result, as long as the loan is out and not repaid, the amount of the balance of the loan is basically held in jail and does not earn the annual interest or dividend interest until it's paid back to the company. That's called direct recognition. And that's the weird one in my view. Remember, watch till the end and you will be rewarded. And hey, we're almost there. Income tax has been around for over 100 years now. And income of every kind is taxed. But the interesting thing about cash values of life insurance is that as long as it stays within the policy, no matter how much it grows, it remains exempt from taxation. Since life insurance is designed primarily for the benefit of the heirs of the insured being usually the owner of the policy. The owner of the policy is not taxed on the gains in the cash value. That's because the IRS views the cash value as simply a component of the life insurance, which again is viewed as simply a future benefit for the heirs of the policy owner. Even though the cash value may be leveraged for loans, which the policy owner benefits from, loans are not considered as income and are therefore not taxed. And because with non-direct recognition companies, policy loans are treated simply as loans from the company. Your cash value continues to earn that high compounding dividend interest while the loans are out. In my mind, that's the greatest value of infinite banking. And with the right company, the policy loan interest is lower than the dividend interest being paid to the policy cash value. And the loan interest charged is simple interest. So in that case, even though you have all your cash value leveraged by policy loans, you're still making gains on your cash value and at a greater rate than the interest being charged on the loans. In effect, that means you get free loans and you're still being paid more than the loans cost. Another mechanism that makes infinite banking such an advantage over traditional financing is the fact that those policy loans don't have any repayment structure dictated by the company that funds the loans. That means you determine when you will make payments on your loans, how often, and how much. And whether you make payments or not, it doesn't affect your credit score. In fact, nothing about your cash value is reported to anything or anyone except you, the owner of the policy. These are the main mechanisms that make infinite banking work. High compounding dividend interest, tax-free growth of your cash value, and basically free leverage loans, which gives you liquid access to your cash values without being taxed on it and without interrupting the growth of your cash asset by the high compounding interest. There are additional factors to consider, of course, when looking into getting started with infinite banking. Primary to these considerations is the company selected to place your policy with and the design of the policy to maximize the cash value growth and availability. That's where a qualified infinite banking specialist comes in. And that's what I've specialized in for over a decade now. So here's your reward for staying to the end of this video. In the description box below this video, you'll find a link that will take you to a page on my website where you can request a copy of my book, Tax-Free Cash Growth Warehouse, The 178-Year-Old Secret. This book details how infinite banking works and the incredible benefits it provides for those smart enough to take advantage of this most powerful finance strategy in history. Click on the link, enter your name and email, click send. I'll send you the PDF of my book, absolutely free. And remember, please like this video and subscribe to this channel. Also, post your questions and comments here. For a complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And free for the asking for you at the link indicated. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. And if you'd like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.